Good morning, everybody, or afternoon. God, what time is it? I don't even know what day of the week it is. I should know this because it's hump day, right, Nancy? Hey, everybody. Welcome to this week's Macro Micro Moment with my partner, Nancy Tengler, and her trusty sidekick, Arthur Laffer. And we have a special guest this week, but I'm going to let Nancy introduce him because I think you're better at it and you know who he is.
Okay, thank you. So this is our guest this is our mystery chart, but it's going to be verbal. He's been right about everything for a very long time. And he runs a number of strategies at BMO, which we're going to talk about. So let's bring in Brian Belsky, and I'm going to start with him on this whole notion. There he is. Hi. Dapper. I'd like everyone to see your entire outfit, Brian.
Well, there's a running joke with me on Zoom calls and in the old CEO at Capital Markets during COVID. I was on so many calls at COVID. I did a lot of emceeing of when we had the Dr. White on talking about the vaccines and those kind of stuff. And the CEO would say, "Okay, Belsky, let's see what you got on." Because I would have the white shirt, red tie, blue jacket, right? And then wearing shorts. So
that's right. That's how it's done.
It works if it works.
That's right. You can pull it off. So as everyone knows, Brian is Chief Market Strategist at BMO Capital Markets. And we're going to talk about a wide range of subjects today, but I wanted to kick off with this notion of concentration. It's all over the financial news media. We're hearing it. I think this is what I've been hearing it be previewed as an end to the bull market. And, concentration is bad. And so I went back and looked. I had the team. I didn't do it. Go back and look. And, we've had lots of periods of concentration. 70s and the 70s and the 80s, it was energy. If you go back to the early 1900s, it was heavy industrials and materials. So I kind of want to take a crack at it and we're going to throw up the first chart, which basically shows the sectors as they are allocated currently. And you'll be able to see that technology is a dominant portion of the total S&P 500. So call it 35.5%. Next closest, as you know, Brian, is financials at 13.5. But once you take out the Mag 7, and that's the next chart, the picture looks very different. And so I kind of have two questions in there for you. So now financials is the biggest sector, and technology is right behind. But there's conversation that this makes, if you take out the Mag 7, it makes the sectors more balanced. I don't even know what that means or why it's important. But I'd love your thoughts on this whole thing.
Well, thanks for asking. It's actually a really important thing because I think what's happened in markets, Nancy, especially the last, 5 years since COVID, especially, we try to simplify our analysis and we come to very quick conclusions. And like you said, the market's been concentrated in different periods, whether that's the 1970s, the 80s, clearly in the mid 90s are very concentrated as well. But I find the most interesting part of this is, remember, the Mag 7 is represented in 3 different sectors: technology, communication services, and discretionary. So a lot of people just simplify it and say they're tech stocks. They're actually not. That's number one. Number two, if those are at least maybe 5, 6 of them are the best companies in the world at what they do, then what's wrong with that? That's just the common sense kid from Minnesota in me. But the other thing too that I think about, much like I think about small cap, and we're going to talk about small cap or two, or we're going to talk about Canada as well, is that it actually excites me. So what does that mean? So if everyone's doing this, I'm going to go the other way. And I think that's given us an opportunity in the large cap money that we run at BMO to pretty significantly outperform the market in our S&P 500 more focused portfolio, because we've had outsized market positions in names like Palantir and Oracle in particular that have really helped us. And so as a portfolio manager doing this for a long time and trying to maintain taxably efficient portfolios that are around, let's call it 22% on average turnover, which is excessively low relative to a lot of our a lot of our competitors. I think that's the kind of way to think about it. The other thing I've been thinking more and more about, this 30% is kind of a magic number traditionally. And we've been doing this for a long time, three of us on the screen today. And 30% usually is the number we got to really worry about a sector when it's that amount of the market. I have a very sneaking suspicion that the index agencies, whether or not it's S&P or Russell or whoever, are going to break apart the tech sector within the next 2 to 3 years. And we're going to have two different sectors. I think it's going to happen. And you know what's really interesting too, just spitballing here. If you take a look at this 34.5% sector in the market, remember at one point healthcare was 15%. Healthcare's really got rocked.
Right.
And I still think that there's some structurally operational issues within healthcare, but we're looking more and more at healthcare from a contrarian perspective. I think fundamentally there's still a lot of issues there. We can hopefully talk about that, but that was one thing that struck me, because at one point healthcare was the second largest sector in the market. The last thing on the financials, man, I'm super bullish financials. And I love this chart, the XMAG 7, in terms of how big financials get. Financials are obviously a really important part of the U.S. market, but I still think for my institutional investors that we talk to, I believe most institutional investors are still very, very, very undersized in their positions in financials.
I think you're right. And are you most specifically interested in banks, or is it just across the board, private credit, some of the credit card companies?
Private credit scares me. It's really scares me for a number of different reasons. It's mostly for liquidity. I have this really weird feeling in my gut about private credit and private equity, circling back to the equivalent of hedge funds in 2008. Many of our big family office clients or big private clients have gone into private equity in private credit, just like they went into hedge funds as an alternative asset in 2008. Right. And I was at Merrill Lynch at the time, and I was the one talking to all these people in September, October, talking about break points and all this with their hedge funds. And it was scary. And I believe that there's a very good chance we get to that again. So to answer your question, and I know there's some notes and stuff, we're talking about bubbles and all that crap. We're no bubble, man. We're not even near any kind of bubble in AI or tech. You know why? Because the man isn't making money yet. Who's the man? Financials. The banks aren't making any money. If you take a look at on a relative basis, we're like baby steps. At a baseball game, we're maybe bottom of the second inning in terms of IPOs, secondaries. We haven't had any stupid mergers yet. When you have M&A, when you have mergers done with stock deals, when you have IPOs peaking and you got a lot of secondaries coming, that's when you're in trouble, Barney Rubble, on AI and technology. And that's when financials will mess the whole thing up again. So we're not even near that. However, given what's happened in these cycles on these stocks, Nancy, so for instance, a couple of years ago, everybody hated Citigroup. Jane came in, cleaned it up. I bought a ton of it, and it's been a turnaround. I think maybe Wells is like that now. Maybe, but remember how Solomon at Goldman Sachs was taking on so much crap a couple of years ago as well. I think investment banking is going to be very, very hot the next 6 to 12 months, number one. Number two, who would have ever thought? I mean, again, the three of us have been doing this for a long time. If we go back 20 years and we're talking about Goldman Sachs as a private wealth powerhouse, you would have never thought that, right? And guess what? They are now. So private wealth's not so bad after all. Lastly, in terms of I would like to call the big box retailers, meaning the last of the big box brokerage firms, or Morgan Stanley. I think they're exquisitely positioned. So I think in the banks, I think it's a tale of two. It's a tale of two tails. The really big banks and the really small banks. At the end of the day, this business is an amazing business, no matter how much we try to screw it up. But it's still a relationship business. So the relationship business of the really, really small banks really, really, really works. In the big banks, it's all about liquidity and scale. The ones in the middle, I really think we're going to see a period of massive consolidation of super regionals and other regionals, because they can't compete with the big guys, and they certainly can't compete with the small guys in terms of relationship side.
I think you're 100% right. You don't need me to tell you that, but that's exactly how we see the market too in financials. But you also said you don't think the tech trade is over. I think you said that. Yeah.
No.
And so today we've been hearing, 2 days in a row, value stocks have outperformed. What's your overweight in your U.S. Portfolios to technology, or your weighting, I should say? I don't know that it's an overweight.
36% in our focus portfolio. I love that value is doing well in all of our portfolios. I was just looked. I mean, I'm going nuts on this daily performance because it's just scaring the crap out of me. Value is our best performing last 12-month portfolio over at the Russell 1000 Value. And oh, by the way, we added Google to our value portfolio.
So did we.
I'm telling you, anytime, we talk about bubbles. Anytime that people make these decisions on binary means that we're never using search again. We're never using search again. Right. Sell Google. Google's one of the most amazing companies ever. Never bet against Google, never bet against Apple, never bet against the US consumer. That's why you got to have Amazon, and then you have to deal around that as well. But I think value, I think 10 years from now, I think I might have said this in the last time we did this. I think 10 years from now, I think we're going to be kicking ourselves if we didn't own enough value in small cap. But going back to tech, I mean, you don't have to own everything. That's the key thing. We typically own 50 stocks in our large cap focus portfolio. And like, as I said earlier, we got into Oracle early. We owned Oracle for years in our value portfolio, and then transitioned more of it into our tactical because it's just Larry Ellison's a genius and he's got a lot of cash. In Palantir, from a management perspective, being a founder and being that engaged and that awesome and a great operator, I'm all in on that. Just like Shopify is another one, kind of like that. Founders have a great management, great track record, blah, blah, blah. But I'm trying to figure out, you talked about how big tech is. So it's really hard for us to have oversized positions in Apple, NVIDIA, Microsoft, because they're so big. So it's hard we kind of dance around being neutral there, and we can be overweight some of the other areas. But on NVIDIA in general, I remember I owned NVIDIA when I was at Merrill Lynch a long time ago.
Wow.
And it was a small mid-cap company.
Yeah.
And he was amazing then. The product was amazing then. But if you think NVIDIA is on the top of the heap, what's Coke and Pepsi? I don't think there's a Coke. I don't think there's a Pepsi to NVIDIA's Coke. I think it's just on a different planet. So what's Coke and Pepsi? I think it might be AMD and Broadcom. It might be. I don't know. But you don't have to own everything. But I like the management of AMD, and I like the product of Broadcom. So I mean, at the end of the day, that's kind of where we've been in technology. Aside from, I think one of the greatest themes of all in AI is cybersecurity. And we had one of our stocks, CyberArk, got bought out by another one of our really big stocks, Palo Alto. I mean, amazing company. And I don't think, like right now, they know where we are. They know where we are, right? They know.
I know. I just got a bunch of pushed emails because I was shopping earlier. So
I mean, so I think cybersecurity, huge deal in the software side of things. And I do think that there's several companies that are going to go away because of AI and because of that. But at the end of the day, I think you own the best in brand and you stick with it. And we're nowhere near the ball. But keep it simple, stupid. When the man's making money, that's when you have to worry.
Okay, I want to come to SMID in a minute, but Arthur, you had some questions about Canada and tariffs and stuff. So, and just for the viewers, Brian manages a Canadian strategy and has a very big presence in Canada. So, where BMO is.
BMO is a Canadian company as well. So, actually, we were talking ahead of time, Brian. I mentioned that I saw you on CNBC. I think it was on the 12th. I'm sure you're on other times, but
he never sees me.
Trust me, I have to see you every day.
Go ahead. Sorry.
And Nancy and I have a bet about where Fed funds is going in September. And we got Jackson Hole this weekend, that's all we hear about right this week. Is that actually probably since last week is Jackson Hole this, Jackson Hole that. Is the Fed going to come out and be dovish? It can be hawkish. You've got the 2 dissenting voting members already. The next group of inflation prints is right before the next FOMC meeting, and it's like a week before. So the Fed's got one more data print before they have to meet next time. But the Jackson Hole's in between. I think you mentioned on that call that you thought the Fed was not going to cut in September. They were going to start cutting later or start cutting in the fourth quarter. Do you still have that view, or what do you think?
Well, our great economics team at BMO, I always like to support the house view. They're saying 25. I mean, from an investment strategy standpoint, in terms of running money, from our view, I know we're doing the macro micro moment, but from our view, we're more micro, and we look at the companies. And from the macro perspective, I think things are still pretty good. I just kind of go back and look at I remember I was looking at 2011 reports we were talking about. And I wrote something about if we could just get unemployment below 11%, if we could just do that. Think about that. I mean, people lose perspective. So I think things are going pretty well. I mean, I still think from the dual mandate's working. I don't know if inflation's dropped enough for them to do that. Wages are still pretty good. The Fed, anytime that the Fed funds futures are controlling the market again, they were so flipping wrong for 2 years. Why are we giving credit again? Part of it is because a lot of people are on vacation this week. I mean, obviously everyone's going to be watching. I mean, everybody. But the majority of institutional clients, they're all on vacation. They're out on Long Island or wherever they're doing. And you have a lot of, that's what's causing a lot of the volatility and quite frankly, low volume. So if we're hitching our wagon to a Fed cut, that could be a buying opportunity because again, with all due respect, the 14-year-old hedge funds managers are going to sell the market if they don't get their 25 basis points and have a little temper tantrum. But I do think a year from now, let's think about this. And I think 6 months from now, rates will be lower. A year from now, they'll be lower. I think we put too much focus on the Fed, and there's so much rhetoric and drama around the Fed chair and President Trump. So I mean, that's control what you can control, and how we look at it is the companies that we own don't need 25 basis points.
And a long cutting cycle is good for risk assets. That's when stocks do extraordinarily well. But sorry, Arthur, go ahead.
No, and then Nancy mentioned about Canada. You've got Canada's, I think, one of the big holdouts on kind of negotiating a trade deal with the U.S. We get the EU behind us. China effectively is delayed with regard to the huge increases, even though the tariffs went higher. But with Carney and Trump, you haven't seen any kind of movement lately on kind of getting rid of this kind of pending doom of the tariff negotiations between the U.S. and Canada. And Canada is very exposed to the U.S. I think I was just looking at some of the export numbers from Canada, and you're seeing steel, aluminum, autos way down, even though overall trade doesn't look bad. But those three are definitely the big losers, and that's where obviously President Trump went after those. Do you see Canada's economy overall doing well? I mean, do you think this thing's going to get resolved anytime soon?
Well, working for a North American bank that's headquartered in Canada, we have the very good fortune of running a portfolio now in November, it'll be 13 years, called the Canadian Equity Plus. It's 2/3 Canada, 1/3 US in terms of our benchmark, and our CAGR is 15%. And I think the reason why we've been able to do so well is that we own Canadian franchises. I'm going to answer your question, by the way. We own Canadian franchises where Canada is really, really good at. You have the cartel, the heads of the five families, the five big banks, and the other one, which is if you do the five boroughs of New York, Yonkers is the sixth borough, kind of, and that's National Bank. They're going to be mad at me if I said this, but they're an amazing bank as well. And then you've got the other big industries, obviously, are energy and materials, and then the rest of it's a bunch of monopolies. And it's a really interesting market, because where we've had the best returns is actually not on those types of stocks. There's a really cool company called Couche-Tard. It's in Quebec. And Nancy probably in Nevada pulled over at a Circle K and got gas. That's a Canadian company. And so Canada is an amazing stock pickers market. I love buying stocks there because about 10 years ago or so, I coined the phrase, and I still can't believe I haven't got in trouble for it, that I believe Canadian investors are the moral equivalent of the mythical creature Eeyore, the flew. Oh, sunny today, but it's going to rain tomorrow. They're always negative, man. They're always negative. If you think about, you answer the question about this economy is amazing. It's amazing. Why is it amazing? It's amazing that they haven't had a deep recession yet. When you go out to dinner in Canada, they will drink at home first and then go have dinner to save money. When they fly in and out of airports or take Ubers, they'll take the cheapest Uber. They are very, very, very good personal money managers. They're very conservative. On the consumer side, they love buying everything at Dollarama. Even though Dollarama has increased their prices for 9 consecutive quarters, they don't know, they don't care. They think they're saving money. I believe, I try to stay out of the politics side of things, Arthur, because I don't really know what's going to end up happening with Carney and Trump. I find it troubling that Canada's held out there. I'm not surprised because Carney got voted in because he was going to be tough with respect to Trump, number one. Number two, what people don't realize too is that 90% of the Canadian population live within 100 miles of the U.S.-Canadian border, and the Canadian GDP is equivalent to the state. The Canadian GDP is equivalent to the states of Pennsylvania and Ohio together. Wow. So that's some perspective, but that's why I already mentioned Shopify, Couche-Tard, Waste Connections. There's and I didn't mention any banks or any energy companies or any gold companies. I mean, there's a lot of amazing stocks out there. So in terms of them slowing down, I think that they have to be careful the next 12 to 18 months because from the macro perspective, as you adeptly said, if Japan's on board, if Europe's on board, and we're going to get Mexico on board as well, and they're going to be left behind, and it's going to be tougher for them to catch up. But again, the proximity to the U.S. and the traditional relationship, not just from friend-wise, but business-wise, will help them kind of get this right.
Wow. There's a lot there, Brian. I didn't know 90% of what you just said.
13 and a half years at BMO. I know a lot about Canada. Plus, I lived in Minnesota for a long time, so I can speak the language,
A.
You know what Americans call Canada, right? Upper U.S.
There you go.
Making friends all over the world. Okay, I actually wanted to share one story and then get your reaction to it. So we have a client who's a mid-sized manufacturer in the Midwest, and I sent you what he said. But we have been talking about, the president wants to bring manufacturing back to the U.S., but we have 450,000 unfilled manufacturing jobs. And so how's this going to get better? And so out of the blue, this client sent to me this note that he said there's a massive shortage of technicians who can service metal cutting and forming equipment. He said they've been hamstrung for months. So nothing is getting done. And he's been talking to his peers, and there are equipment brands out there that have 13-month lead times on services for specific manufacturing of steel, and he makes outdoor furniture. So his feeling is that we're going to see a big snapback when this log jam in technicians goes away. I don't know. What do you think? I mean, manufacturing is not recovered. We own a lot of industrials that have done really well, but what do you think about this? Like, how are we going to solve this problem? Is it a problem? What are your thoughts?
I think it's a problem, and there's a growing issue with university costs and all the politics and rhetoric surrounding all that. And I just know firsthand, from one of my best friends in college roommate, best man in my failed marriage, his nephew, his nephew going to trade school.
Marriages and one widow.
What's happening, Nancy, is this is really, really cool. Okay. Trade schools are not templating it. Trade schools are accelerating those people that can accelerate in their craft. It's happening. It's happening. So this young kid, he's an amazing young dude in Minnesota, going to electrician school. He's so smart that they're accelerating in. He's going to graduate early. I'm hearing that in plumbing. I'm hearing that and other things. That's number one. Number two, we at BMO have an amazing franchise in the commercial bank side, especially with our lineage of M&I Bank and just the notion and kind of model of BMO really works in the Midwest. And I keep talking to the commercial bankers, and they're on board. We got a lot of clients that have cash and they can spend, and they're just ready to go. So I'm 1,000% on board with a snapback with respect to what's going to happen in the Midwest, especially in some of these industrials. Then you also think about where the GDP growth is going to be coming from in our country. I think it's going to come from a lot of areas that are more tax friendly, the Southeast, some parts of the Midwest, some parts of the West, kind of cheaper living as well. So I think there's a huge snapback coming in terms of industrials and housing. And I don't think people are prepared for that.
I think that, and that's how you invest in this is what you're saying. Yeah, I agree with you 100%. We've got all the foundries going in Arizona. And we started, and that's a long process, but we're about 2 or 3 years in with the TSMC and Intel plants. But we also added to housing a couple of months back. And then, as he always does, Warren Buffett copied our trade in DR. Copied my trade in Apple in 2013 or 14, whenever that was. But I think you're right. I think and DR Horton has the benefit of being in the Southeast and the Southwest. And more entry-level homes. So interesting. Okay, that's fantastic. I'm glad to hear that, because I'm worried about this whole manufacturing issue and how we're going to solve it. You can't solve everything with robots.
Nope. You still need people to go to electrician school and fix the pipes, and that's why too. I think like they call OG utilities are going to be the big winners, because they have all the cords, man. They got the wires. They dug the holes. How can we power all these things without electricity, man? So I think you just got to keep it simple, and I think they're going to be big winners too.
Yeah, agreed. And I was reading about photonics this morning, and then I went back to sleep. Just kidding. Okay, earnings, and then SMID. And then you talk about whatever else you want. So we saw a pretty good earnings season. I'd like your thoughts if you agreed. I gave you a note from our friend Tom Lee that shows cumulative US 62% earnings growth for over the last 5 years. And then rest of world is at 30%. Next closest country is India at 50 plus. So are you still thinking like US is the best stock market house on the block? And then what do you think? What did you make of earnings?
Yeah, I do. I think it's the nicest thing about that. The neighborhood's getting better. We're not the best in a bad neighborhood. Best house in a bad neighborhood. I think the neighborhood is actually getting its crap together, which is good. But you still, the way I think about it, investing in general is, buy scarcity, sell capacity, and I still believe from an asset perspective, in terms of just the asset that an equity is, we still have the best companies in the world. We have the best ingenuity, and we have the best management teams in the world. Just in totality, there's going to be some offshoots in that, but I still think you get what you pay for. I'm not saying valuation doesn't matter, because it does. Get what you pay for in terms of just the how great the companies are. Then you go back to COVID. If it wasn't for companies in the United States, think about it. From Netflix to Google to Apple to Amazon to Microsoft to Costco. So at the end of the day, I still think that's it. In terms of second quarter earnings, earnings were pretty good. The earnings were better than everybody thought. Shocker.
Yes.
We were pounding the table on earnings because one of the things that we looked at was earnings revisions were excessively low. Moving forward, numbers were really, really low. Everybody dropped their numbers, meaning all analysts. So when consensus all is following the herd, that's when earnings are going to be set to outperform, and they exactly did that. That's kind of number one. Number two, in terms of top line, was pretty good. Margins.
Isn't that crazy?
Crazy.
Yeah.
Crazy. And then expectations still, the forecasts are still looking pretty good. I think the key thing is that on the tariff situation, and Arthur asked a little bit about that, is that there was this knee-jerk reaction that everything's going up. We don't know. price. They're going up in the tariffs. But oh, by the way, we still don't know. We still don't know exactly who's going to be taking the brunt of it, even if there's a brunt, whether or not it's the actual producer or it's the consumer on that. So that's why margins have not been hit. Nobody's talking. Lastly, I'd say if you still look at going back in the best house in an improving neighborhood, we really look a lot at operating performance and free cash flow and debt to equity. If you look at these types of things from a broader sector level, the majority of sectors in the S&P 500 look really, really good still. And from an industrial perspective as well, you want to start looking at industrial stocks when the operating performance things like return on equity and return on assets are just beginning to turn. That's why I think we're going to be a liftoff. So I think the composition of performance in 2026 from the market's probably going to be a little bit more different. And I think that's actually a really, really good thing.
Yeah, agreed. Arthur, did you want to ask any more on tariffs or?
No, I think we've enough on tariffs.
The tariff.
I know we're hearing about tariffs.
What's going to be, if tariffs are going to be, tariffs obviously the last, whatever month it is, it's August. Over the last 8 months, clearly, or 9 months, tariffs probably going to be the most searched word on the Google machine. I wonder what the next year is going to be the most searched word is going to be. I don't know.
Yeah.
Where did Powell go?
Yeah, where did Powell go? Writing a book, man. He's going to write a book. He's going to go on a speaking tour. He's going to be making a heck of a lot more money than all three of us. It's going to be fantastic. And he's going to be living the life. Exactly.
All right, so tell us about your SMID. I know it's done just incredibly well. I think for me, the cool thing is you maybe get to make acquisitions, some of those companies, but a lot of times they get taken out like CyberArk, which is awesome. So do tell.
I didn't buy CyberArk to get bought out. I bought CyberArk because it's an amazing company and product. I mean, those are the best kind of stocks. So, I mean, we also had Synovus Financial merge with someone here recently. And so that's been part of our strategy to own kind of some of these small mid-cap companies. I like to buy companies that play a story. Like I've owned On Shoes for 3 or 4 years because I think it's just a fantastic product and it's worked out really well. When we originally came out with this portfolio, it was probably 18. We owned a little company called Spotify. It was $15 billion at the time, and it was in our small mid cap. And you love it when your kids grow up. So we put it now.
Did you sell it? Did you sell it?
No. I moved it from my SMID. It got too big. And moved it into our large cap. No. I think that's one of the greatest companies.
We did too. It's in our 12 best, and
I love it. I mean, someone that loves Apple and was schooled by the great Gene Munster in 2005 on why I should be buying Apple. Spotify's better at Apple with respect to some music and things like that. But the coolest thing that I love about the SMID is that you get to play themes and stories. And that's how I grew up in the market in the late 80s and early 90s. Like I was talking to my son and just through living life. And I was talking about the Celsius stuff. I said, what's this Celsius? He goes, Daddy, I tried. It's healthier than Red Bull. I said, I don't think that Red Bull stuff. And you drank Celsius. So this was, I don't know, 3 years ago or something, maybe 4. So Celsius has been just like a home run for us because it's a great product, but you can play the themes. We love the theme of building. So we bought Top Builders recently. We've owned KB Homes for 3 years in this portfolio, waiting for things to go. We own United Airlines because it's more of a mid cap name. That's been a great player for us. We have a bunch of like Glacier Bancorp is that Montana Bank. It's one of my favorite banks because talk about relationships in the like. So the SMID, it's a fun portfolio to run because there's volatility. And we have more names than that, around 65 names. That's a lot for us relative to 50.
Right.
But it's a way for us to really delineate themes. And again, lastly, one of the themes I love the broker-dealer business. I love it. And I grew up at Dane Bosworth and then Piper Jaffray and then Barrow.
Oh, wow.
And so Stifel's a name that we've owned for a long time. It's a great brand in terms of, and a lot of my former compatriots ended up there, but so is Raymond James. Those are really great those are really great brands, and they love the broker-dealer business. So I've owned both those names for a long time, and they've done really well. So again, SMID, you can play more themes. Where large cap, and you have to be more careful and more index kind of oriented. Can I beat the index? Where I think in SMID, you can really have longer term kind of plays and let them run.
So last question on SMID. That's awesome. What is your capacity in terms of assets to be managed in your SMID?
You know, since we're sub-advisors, and we're just handing off the model, we in the prospectus and how they set it up at BMO, we can't, I think like 30 billion is the largest we can get into that, and but we don't. I try not to go, Nancy, below 500 million market cap, because then you have some liquidity issues.
Yeah.
And again, because we that portfolio is offered both in Canada and the United States. We have, and it's a bank. We're not going to go. I mean, Celsius, or at one point we owned Sonos. They had some operation problems. A great company.
Yeah, I owned that too.
And we punted it after. Fool me once, shame on you. Fool me twice, shame on me. In terms of quarterlies, but we have to kind of be careful. We don't go way out there in terms of very volatile names.
So what do you want to say before we close out? Like, is there something we didn't ask you that you think is super important right now, or your year-end target? Are you sticking with it? Where are you on?
Well, yeah. So thanks for bringing that up. So we published our year ahead piece for 2025 earlier in right after the election, because most people wanted to kind of get things straight. So we were the first to put it up. And we initiated at 6,700. People thought we were nuts, and then everybody kind of caught up with us. And then the April temper tantrum happened, and we did move our target down to 6,100. The only reason why we did that is because we were very clear in our note that we wrote. Number one, we're not changing any portfolios. We're not changing any positioning. No sector weights. No stocks. Nothing. And I said in bold letters, I said, we own what we own. So that resulted in the best quarterly performance I've ever had in over 20 years of technically running money, ever. Now, I've also said this, no offense to all the very much more dapper, handsome, smart, qualified strategists out there on Wall Street. I believe strategist targets are this really cool word. It's bunk. It's bunk. I'm not going to manage money because JP Morgan says the market's going to go X, or BMO says the market's going to go to 6,700. Who cares? By the way, it's an academic practice, and everybody's got a different process. And so we have two models that we run: a dividend discount model and a regress model on PEs. Really interesting is that we used to run 3, and the third model was a macro model. It's been so wrong. So we used to take the 3 and then come up with a median, and that was the target. It blew up everything in terms of our methodology. So we have not used the macro model since pre-COVID, and it's actually been a great call, because if you're looking at macro stuff and then trying to lag it or move it forward, it has not worked. And the problem with a lot of macro strategists that couldn't pick a stock to save their life, or they're looking too economic, they're looking too technical. Everyone's a technician right now. So we said that exactly right. It's an academic practice. This is just, we have to, discretion is the better part of valor. When you're looking at a market that was having a temper tantrum based on exogenous events, there was nothing fundamental in my view going on in April. And so we said, you know what? We're putting it down 6,100. And then guess what? We went back after our signposts that we needed to see came back, which we said, signposts, we need to see a discernibility and stability in earnings. Boom. We need to see less and less talk with respect to all this macro machinations in terms of tariffs out of Washington. Boom, we saw that. But most importantly, we started to see guidance start to come back. And if the majority, and here's the way I looked at guidance. Everyone pulled their guidance. So you think about it in a contrarian way. If 500 companies pull their guidance, can't get any worse than that, man, right? So once it starts coming back, that's why I moved the market back to 6,700. So our bull case is 7,000. Do I think it's going to be closer to 7,000 at year end? Yes, I do. To remind everybody, we came out with our original bull market call in 2008 and then refined it in 2009 after we got pushed out of Merrill Lynch and joined Oppenheimer. And then in 3 years in a row, we refined the call. So bull market in 2008, big bull market in 2009. And then in 2010, we came out and said 20 to 25 year secular bull market. We've been consistent on that. We're not bullish just to be bullish. We're not Pollyanna. We have a process. We have a discipline. We have models that go back to when I first started this business a long time ago. We follow everything religiously. I just think that this is one of they're going to be doing, I don't know if, 30 years from now, Nancy and I don't know if they're going to do white papers. I don't know what the hell they're going to call it. They're going to do something. There's going to be a movie. There's going to be something on the last 25 years. It's going to be the most amazing stock market period in the history of investing. And we're probably, we're 10, 20, 29, 50, we're 15 years into it. We got another 10 years to go. We do.
Love it.
And I'm not saying it just because I'm bullish all the time. I really, really believe it. So you go back into the best house in an improving neighborhood. That's really, really important because everybody and their mother, brother, sister, cousin, uncle got all excited and hopped up on Mountain Dew to buy Europe at the beginning of the year.
Right.
Now how's that working? They still have structural and operational issues. At the end of the day, it's great. It's great to buy stuff because it's way down and it's been underperforming, but it's still at the end of the day, it has to operate and perform fundamentally, and that's what you get with U.S. stocks.
Yeah. No, couldn't agree more. And I think it's interesting in our business because if you are positive, people think you are a Pollyanna because the bears always sound smarter. Like the guy
they're so articulate. They're amazing because they got all this massive data. Some bear will come on and say, well, they give me 8 different ways and 8 different models on why I'm wrong. And that's okay. But here's the cool thing. I think in this business, you absolutely positively have to have humility. And I don't know everything about it. I don't have to own everything. I don't know about everything. I don't know anything about crypto, and I'm not worried. It's okay, man. I don't have to know about everything, man. And I think that's okay. That's called humility. And I think sometimes in this business, we try to be the smartest person in the room. I've never claimed to be the smartest person in the room. And I think that's how a lot of people that do what I do get themselves in trouble.
Yeah, no, I'm with you on the humility. We talk about it, Arthur and I, a lot. I think that's one of the things that Fed Chairman Powell lacks is an ability to be humble about his mistakes. I mean, I don't mean for everything to always come back to this, but to be humble and then to learn from his mistakes.
Exactly. I think one of the biggest problems with the vid, as I call it, was the coolest thing about our jobs is that you get to interact with people. The best job training ground I ever had for this job was a bartender. I bartended, I paid for my college and my wedding, bartending, and it's the best way to talk to people. And I think what happened at COVID is we were on screens too much. We don't know when people are lying. We don't know how to do judge facial stuff and everything. And I don't know about you guys. I'm kind of spitballing here a little bit, but his facial gestures, his body language has been absolutely atrocious the last 6 months. And I haven't seen anything from Jackson Hole yet, but I'm guessing it's going to be very different than when he was quite authoritarian and quite clear and concise in 2020. That was a really important Jackson Hole in 2020. He was on brand and he was on set. It's going to be interesting to see what kind of body language and facial gestures. I don't know if you've noticed that at all.
Oh, yes. Yeah, agreed. I was on CNBC actually with Larry Kudlow when he was still doing CNBC, the day that Powell went to his Humphrey Hawkins testimony. And we both were like, oh, it's so refreshing. He speaks English, he's articulate, but I think the biggest damage he's done to himself, and it's evolved what you're talking about, this lack of confidence in how he articulates and conveys himself. I think he just should cancel all these press conferences with you're talking about the 14-year-old hedge fund managers. I'm talking about the 15-year-old journalist that asks him questions he doesn't answer and then they don't follow up. So but I got us off track. Sorry.
No, I think it's true, but it also speaks to what I talked about peripherally before, is that you hear one thing, then we're going to go. This rush to judgment thing, and I think it actually is it's a microcosm and byproduct of texting. And I know I'm sounding really like, archaic.
Like a dad.
Pick up the phone, man. Use the voicemail function. It's okay. Dad, I called you. No, you didn't. In this call, leave me a voicemail.
I would like to say, I talked to him and I said, did you talk to him? Or did you talk to him? I mean, there's a big difference. Well, I want to congratulate you on, an amazing career, obviously, but also just your performance, the way you look at the markets. I'll even go with humility. And I appreciate that so much as a friend and as a professional colleague. So really.
Well, thank you. Again, I've been so blessed. I have an amazing team that has stuck with me. One person's been with me for 18 years. I've been very blessed to be a BMO for 13 and a half years. They've been great. And I think life is like investing, and investing is like life. It's just a bunch of stories and it's a bunch of relationships. And the legacy is not about being smart or anything like that. It's about having relationships and what they've done for you and what you can do for them. Making money is fantastic, and that's a wonderful goal. But at the end of the day, when I see somebody and they know they're going to get the obligatory, not obligatory, the usual Brian Belsky hug, that really means a lot to me. I saw this guy in New York City outside the hotel, I'm talking about, that used to be a really, really big client institutionally. He worked at TCW, and I hadn't seen him in 3 years. And he starts screaming my name, and he put his hands up like this for the Belsky hug. That's what this business. That's what the greatest thing about this business is.
So Arthur, for the record, I've never gotten a Belsky hug. I want that on the record. Okay, well, thank you, Brian. I know you're about ready to go out to the beach and go for a run. So thanks for making time.
Thank you so much. Again, I'm excessively humbled. And Arthur, I always love going back and forth with you as well. You guys have been great friends and great benefactors. And I really, really appreciate the time.
Likewise.
Yeah, thank you. See you soon. See you in New York.
Take care. All right.
Hoping for that hug.
Yes.
All right.
See everybody next week. All right. Next week, same bat time.
Yeah. See you then. Yep.
Thanks everybody for joining us. And don't forget, you can ask questions if either real time, or you can even send them in if you want to ask us questions on LinkedIn or email them in. We'd love to answer whatever anybody might have on any of the stuff we talked about here.
There's a landline ring.
That's mine.
All right. Thanks again. We'll see you next week.
Bye, everybody.